Here's my prediction of the global financial markets and where they're going. It's inevitable. Now look, I give you a lot of financial analysis and I tell you what is possible, what is probable, but today I am going to show you what's inevitable. I'm going to show you where we're going, and I'm going to bring a lot of clarity to the financial global macroeconomic outlook, if you can just zoom out. So in this video, I'm going to break down the charts. We're going to look at the data, look at the numbers, we're going to look at the policies, and I'm going to show you, we're going to bring certainty to this because I'm going to show you what is inevitable, what's going to have to happen, and what we should do if we want to be prepared and have the money just flow right into our accounts, which of course is what I want. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong. Almost everything we see, it's hard to understand. There's so much information, and if you're confused, don't worry. It's not your fault. There is so much information coming from every which direction, it's hard to understand what to do next, and I'm going to show you what I believe is inevitable. We're going to take the uncertainty out, and I'm going to show you the numbers, the facts, the charts, what the constraints are, and where things are going. Now, I want to tell you real quick, before we jump into this, just disclaimer, on YouTube, there's spammers, so you're going to get tons of comments on your comments, potentially telling you to message me on WhatsApp and things like that, or on Instagram, they'll follow you, which, by the way, my real account on Twitter, Instagram, and YouTube is just @1MarkMoss. If it has spaces or dashes, that's not me. And comments on your YouTube telling you to contact you on WhatsApp, that's not me. However, if you do want to contact me, there's a link in the description where you can actually set an appointment and you can talk to my team to find out what courses I have available, how you can find out exactly what I'm buying and selling, my live streams I do every week with my members, my events we do here at my location. There's a lot of ways I can help you. So if you want to talk to me and my team about that, there's a link in the description, but ignore all the stuff in the comments, all right? Just disclaimer, people lose money, it's no joke. All right, let's talk about this. As you already know, the Fed, they're waging war on inflation. We've talked about this for a long period of time, but just kind of a real recap here, going back to June of 2020, so here we are a couple of years ago, almost 3 years ago now, Jerome Powell famously said, we're not even thinking about raising rates. The Fed had not been able to get inflation for years. They were trying, they were injecting liquidity, they could not get the inflation. When the market seemingly started turning around, and this is a few months after they started injecting liquidity, things started going up. He said, we're not even thinking about it. We're not going to do that. Then he went on to say here in April, the next year, so not quite 12 months later, April of 21, the Federal Reserve calls inflation famously transitory. Okay, we see it, but it's going to go away. We've never been able to get it, so it's going to go real quick. And then here we go real quickly into November of 21, so just a few months later, that's how quickly things change. Powell admits the Fed got it wrong. He says, who could have ever seen it coming, right? Who could have ever seen it? And of course, they look horrible, they look stupid, they look irrelevant, and they are. And so now they're trying to save face. So that's, they're waging a war against inflation, all right? The problem is they're losing. Not only are they losing the war of inflation, they're wrecking everything else, and they're even making the government bankrupt. We're going to talk about that in a second, but as you already know, the Fed has embarked on the fastest Fed funds rate increase, the interest rate increase that we've had in history. Look at that. It looks like what Volcker did in the 80s looked like child's play. It's massive. But the problem is, no matter how fast they've raised this, he says they're crushing demand. They want to make people broke so they don't spend as much money. That way they could bring prices down. If nobody has any money, no one can afford gas, then the price of gas comes down. That's his thinking. The problem is, as he's wrecking people's retirement accounts and home values, and people can't afford eggs at the store anymore, while he's doing that, inflation's not coming down. As a matter of fact, we can see the 3-month annualized super core inflation is up. You see that right here? It's actually going up. So no matter what they do, they're wrecking everything. It doesn't matter. It's still going up. And then we have right here, the Atlanta's Fed wage growth tracker shows that wages are up 6.1% in January. Now, this is a real big problem. The Fed does not want your wages to go up to keep up with inflation. They want your wages to go down. Because when wages go up, that's inflationary. So the fact that people are making more money, that's a problem for the Fed. So they're losing. No matter how bad they wreck things, they're losing the war against inflation. The problem is, every time that sticky inflation doesn't go away and we have another high CPI print, or the economy does good, or unemployment stays low, or whatever, you hear this. The analysts are saying, well, the Fed has to keep raising rates. The Fed needs to raise rates. We're going to have to move rates higher and leave them for a long time. How high can the rates go? That's the problem. How high can they go, and for how long can they sit there? So let's take a look at that. Already we know that the government, the U.S. government, the Treasury Department of the U.S. government that manages the Treasury, manages the bank account for the government, is going broke. We saw this, report from the Treasury, the receipts for the first quarter. You can't really see it, but this line item that's in red right here shows that the tax receipts, the revenue for the government, went down by 9%. Why? Because people are broke. Why? Because the Fed's trying to make them broke. So while the Fed is making people broke to push inflation down, they're also making people so broke they don't have tax revenue, which makes the government broke. And the government is going broke so fast that, in fact, right here, they announced that just for the first quarter of this year, for 2023, they had to borrow almost $1 trillion. Almost $1 trillion. It was $932 billion. $932 billion in just one quarter. That's $4 trillion a year we're on the pace for. And in order to save themselves from going bankrupt, they have to do lots of tricky accounting maneuvers. Little magic, accounting maneuvers. Things like, how about let's not fund the retirement accounts? How about let's take the money we're supposed to give to our pensioners, the money that we owe people, and let's just move that over here. Accounting maneuvers to keep the government from going bankrupt because the Federal Reserve is fighting inflation, but in order to fight inflation, they're actually making the government broke. All right, now to understand this a little bit better, let's take a look at the microcosm that is California. That is the fourth largest economy. If it was a government, a nation would be the fourth largest in the world. And it's great to understand it here, and then we'll take it a little bit bigger. But California leads the way. They say California leads the way for the nation. So they lead the way for the nation in getting off fossil fuels and going to renewables. It's worked horribly. Electricity prices are the highest, and we're not going to go into that. But what happened in California is that they have both a spending problem, and they also have an income problem. Sound familiar? So they want to spend lots of money like the government. Like the government just did the 1.7 trillion omnibus, and California also wants to spend all the time. Now they're giving money to black people if they're pregnant, and they're giving it to trans people, just throwing out money left and right, $25 billion for illegal immigration, things like that. And what we saw is the government of California went from a $100 billion surplus, extra money, to a $25 billion deficit in only 10 months. Only 10 months. And part of that is because they have a spending problem, right? They've been spending more and more money, but it's also because they have a revenue problem, an income problem. Corporate tax revenues, the amount of money that corporations pay, went down by 20% in January as compared to the year before. 20%. And total tax revenue is down 40% year over year. Why? Oh, well, the Fed's trying to make everyone broke. They're trying to crush demand, and it's working. But the problem is that the states are also going broke. California has a big deficit blow up, and that's just a small example. Like I said, it's happening all over the United States and the rest of the world. We'll look at that. So the U.S. has the same problems. The U.S. wants to spend more money, but at the same time, their income is going down. So we can see that, like I said, in California, the top 1% of income earners pay 49, almost 50% of the income tax, the top 1%. But it's also very similar in the United States. You can see that here. California top pays 1%, pays half. But in the United States, the top 5% of income earners pay 60% of the income tax. You can see that here. So here's the top 5%, and this is 60% right here. The bottom 50% pay about 2% of the tax. They should pay their fair share. That's what Joe Biden says. What's their fair share? The top 1% pay over 40% of the tax. So what's their fair share? Anyway, as you might imagine, the top 5% that pay the 60% nationally, or the 1% that pay for the 49%, they don't earn on W-2 income. Their taxes are not getting withheld. That's not how they get paid. They get paid through things like bonuses and dividends and stocks and things like that. And so when asset prices go down, guess what happens? They don't have that money, they're not collecting it, and they don't have to pay. In the case of California, most of these 1%ers here have left the state. They've moved to places like Texas that don't have state income tax. And so this is a big problem, but it's happening all over. Like I said, California is a microcosm, but it's happening all over. All right, now to understand this for the United States government, we have to understand the expense side of the equation. And so there's true expenses. I've talked about this before. You have your mandatory expenses and then your discretionary. Mandatory is for you personally, you and I personally, would be our mortgage payment, our car payment, our electricity bill. That's mandatory. Or you lose your house and your car and you live in the dark. The other expenses, discretionary, would be going out to eat, your clothes, things like that. So we look at the government mandatory, or what we'd call true interest expenses. And we want to look at it as a percentage of income or tax receipts. And what we can see is that we can chart this out as a percentage of GDP. And this is going back to 2016. And what we can see is during COVID 2020, in the height of the pandemic, the decline in tax receipts went down so far and so fast, of course, because they literally shut down all the businesses, that they had no revenue, and it reached almost 120% of true interest and GDP. Now, this doesn't include things like, all the welfare they want to send out, and UBI and all the other programs. Doesn't include Department of Defense, none of that. This is just the mandatory expenses. That's basically entitlements, Medicare, Medicaid, Social Security, etc., and the interest. It's Treasury spending and the entitlements. All right, that's what we're talking about. But here's the problem. We've been able to come back down to right here, and now we're rapidly coming back up. We're not quite at the pandemic levels, but if we go into a recession, which it looks like we are, of course the Biden administration changed the definition of a recession, but if we go, a very mild recession would typically see a 20% decline in tax revenue because businesses aren't paying as much, people don't make as much, right? So if we say we have a very mild typical recession and we have a 20% drop in tax revenue, and we have a 4.5% federal funds rate, which we're over that now. But if we have those two things, then we would expect to see, and a 12% increase in true expenses. So they're going up, so we've had to increase the amount of money paid out to Social Security. We've had to increase those because inflation. If that happens, we're going to see this exceed where we were pre-pandemic. Now you remember what happened during the pandemic. The Federal Reserve and the Treasury freaked out and had to dump in over $10 trillion to keep things moving. But now they want to be tight. They're not going to put money in. But it looks like we're on the course of this happening. Now, we can play with these numbers in a couple ways. Let's just say that we only have a 10% decline. Maybe we're not going to have the recession. It's not even going to be mild. It's going to be barely a blip. It's only going to be 10% decline. But we have a 6% Fed funds rate, which people say we're on our way to doing that. We're going to end up in the same place. Now, this is the mandatory has to be paid. This is not all the other additional funding that the government does. That's the problem that we're in. And the problem is we have to service the debt. All right, there's about $31.5 trillion of debt just for the government, and there's interest on that debt. And we have to cover at least the interest. If you can't cover the interest, you're technically a zombie company, all right? And so the government is technically a zombie government because they can't even cover that. And what happens is as those rates go higher and for longer, remember, every time inflation comes out high or a jobs report comes out good, people say, well, the Fed has to raise rates more. But higher rates equal higher payments. On $31.5 trillion of debt, you can see how fast this is going up right there. That is a really big problem. Now, if we want to look at the future, what we can understand is that the government takes debt through issuing treasuries. And treasuries are typically denominated in time frames, 6 months, 2 years, 5 years, 30 years, whatever it is. So all this debt isn't due right now, and it's locked in at low interest rates. All right. However, what we can see is that the current U.S. Treasury debt of about $31.5 trillion has a an average rate of interest of 1.7%. So it's fixed, it's pretty good. But the problem is these durations are coming due. And what we can see is about 50% of the 31.5 trillion, 50% is maturing and is gonna have to be refinanced in the next 3 years. Now, with Fed funds rate in the 4.5%, 5% range, potentially even 6% range, all of that debt, 50%, that's getting refinanced is gonna have to get refinanced at this new 5 or 6% number. This is from the Treasury directly. You can see here's the amount of debt that's gonna have to get refinanced. As a matter of fact, all of this, 28% of it is in the next 1 year. 28% in 1 year. How are they gonna take it higher for longer? If you figure that out, let me know. All right, so keep going. And on top of that, so we have this increase in expenses, interest is going up in a really big way, and the drop in tax receipts. We already talked about that, but I want to show you these charts. It's actually the biggest tax drop in history. And I'd love to show you the charts so you can understand this. Here we go all the way back till 2007. This is the 2008 crash right here. They dipped a little bit, but here we are right here. Look at that dip. Biggest tax drop in history. Here's the monthly change in personal taxes. Look at that candle. That is insane how fast this is going down. So what you don't want. You don't want expenses going up and income coming down at the same time. All right, so now I'd like to show you the data, but I also like to show you the data from the government. So the government actually has offices that put this out. One of them is called the CBO, the Congressional Budget Office, and they actually put out the data. And what they're showing us is that our projected deficit, our shortcoming, how much more our expenses are than our income. And what they show is that they expect our deficit to grow. They don't believe, they don't even think, they don't believe, they don't have faith, they don't even dream that we'll ever be able to pay it off. They actually expect it to get much, much worse. And as a matter of fact, they are way undercutting it. I don't have the time to dig into all the data behind the numbers, but their numbers are very rosy. Like, for example, they show there being a very mild recession in 2023 and no more recessions for the next 15 years. That sounds pretty rosy to me. I don't know if we're going to be able to do that. They also give us this chart right here, and you can see here we are right about here, and this is the federal debt held by the public from 1900, almost none, till today, as a percentage of gross domestic product. Now, you've heard me talk about this a lot. Typically, when a nation gets over 125%, it's game over. They don't typically come back from that. 125% is right here. And this is where they project us to go. This is from the government. Do you see what's going on here? As a matter of fact, they put out this report, and in 2021, they put out a financial report, the US government did, and they titled it, An Unsustainable Fiscal Path. That was the name of their own report, the government. And in it, they showed us this chart, and they showed historical and current policy projections for debt held by the public, and look at what they expect to happen. This is from the government. This is what they expect. It says, quote, in the report, quote, the projections in this financial report show that the current policy is not sustainable. That's what they said. That's their words. So let's keep going. Now, this is not just a California problem. It's not just a United States problem. As a matter of fact, it's a global problem. The global debt to GDP was 100% in 1970, and today it's over 250%. This is global. This is a chart from the IMF, the International Monetary Fund. So when I say I'm going to bring to you some clarity of what's going to happen in the future, I believe with certainty we know exactly what happens in the future. And that's because we have the data. It's math. Like my good friend Greg Foss would say, it's just math, all right? You can't get out of this. So there is no choice but to debase, meaning to print. There's just no choice. They don't have enough money, there's not enough income coming in, and they're going to have to print the money for the difference. It's the only way. The rate of debt increasing is slowing growth to the point that we almost have no growth. We can't grow our way out of it, which is why these charts keep going up. The only option is for them to print, period. That's it. Now, if you know, where does inflation come from? Leave me a comment. Where does inflation come from? Oh yeah, increasing the money supply. So if they have to print money, increase the money supply, what do you think is going to happen? It's going to be inflationary. It's the only way is to keep printing. Now, wait, there's more. It even gets better. What am I talking about? War. War is inflationary. War is massively inflationary. As a matter of fact, we can see here the Pentagon is now saying that China is going into war with Russia and is going to start supplying them what they call lethal aid or weapons. This is a really big deal. So China now wants to potentially arm Russia, because if Russia gets defeated, how will China get all its commodities? China needs all the natural gas and all the oil and all the rare earth minerals from Russia. And if Russia gets defeated, China gets defeated. Now the enemy my enemy is my friend. The US has been attacking China. I've covered this. We took away their ability to get microchips, right? We've now sanctioned them, all these different things. And so they know that if Russia goes down, they're all by themselves. So now they've partnered with them. And we can see here, here's Secretary Anthony Blinken. He says that financial sanctions are now coming to China, and most likely China will not be investable for U.S. investors anymore, and people that have money invested in China may not get that money back. So if we continue to disrupt the equilibrium between China, the world's largest exporter, what do you think happens? It's inflationary. Supply chains continue to break down. We don't get the goods that we need, and on and on and on. And on top of that, the dollar is under massive pressure. So at a time when the government needs to print more dollars than ever before, the dollar is under massive pressure. Nobody wants it anymore. As a matter of fact, this report just came out from China. This was just a few days ago. It's from the Ministry of Foreign Affairs of the People's Republic of China. This is their official publication. It's very long. It's worth reading. I pulled a couple excerpts out of this. So here is what the government of China put out for the whole world to read. The Ministry of Foreign Affairs of the People's Republic of China. They said that the U.S. exploits the world through seigniorage. So because the U.S., they said the U.S. can print a $100 bill for 17 cents. But another nation has to come up with $100 worth of goods to get the note that the U.S. spends 17 cents on. That's what seigniorage is, and they're not wrong. They said that the dollar is a worthless piece of paper that's only used to plunder other nations. What do you think China's sentiment is towards the United States? Russia's is, the BRICS nations. It's a worthless piece of paper that's only meant to plunder the wealth from other nations. They said that the US dollar is the main source of instability in the world. And they said that the US is boldly interfering in other countries' elections. They also said that the United States has been behind every color revolution since 2003. And they named them all off. The Rose Revolution, the Orange Revolution, the Tulip Revolution, they named them all. They basically have, and I didn't fact check this, I'm just saying this is what they're saying. So they're saying that the U.S. is the purveyor of terror. The U.S. plunders other nations with their dollar, and they want to get away from it altogether. So at a time when the United States needs to print all this money, the dollar's under attack. It's under massive pressure. Now, here's what people are doing about this, and you and I should probably take a note. This is what I'm doing. I talk about it all the time. There's a switch to commodity reserves. Nobody wants to hold dollars anymore. They want to hold reserves. I've been talking about this, like Zoltan Pozar talks about a Bretton Woods 3. We went from a gold-backed currency to just a fiat currency, and now a commodity-backed money. So what am I talking about? We saw, this came out just this week. Central banks bought the most gold on record last year. Not the most gold in a decade or the most gold in 2 decades. No. The most gold on record. Central banks bought the most gold on record. They don't want to hold fiat currency. They would rather hold the commodity. Check it out. General Motors, the car manufacturer, invested $650 million, over $500 million, to buy a U.S. lithium mine. Why? They would rather have the commodity in the ground than the dollars in the bank. They know that those dollars in the bank won't buy them enough lithium in the future, so they'd rather own the lithium today. That's what happened. That's how we go to hyperinflation. When people don't want to hold the dollars, they'd rather buy the commodity. It's not just General Motors. Volvo is in advanced talks on buying a lithium mine. So Volvo also wants to do the same thing. Battery giant LG Chemical prepares to lock in other mineral mines as well. They're trying to do it. China tightened its grip on dominant LNG. So China just locked up all the natural gas. They would rather buy the gas than have dollars. They don't want them. Nickel gets fresh supply risk from Philippines. Russia plans deep March oil export cuts. So Russia has been exporting their oil, but they're like, hey, why do we want to keep pumping out oil and just holding fiat currency? We'd rather just keep the oil in the ground. You see what's happening right here. They would rather hold the commodities than the currency because they know it's inevitable, just like I'm breaking down to you, which is the only way out is debasement. Now, of course, in my opinion, the best commodity in the world is Bitcoin at this point. It's the only cryptocurrency that Gary Gensler has said is the only one that's a commodity. All right, and I can make a whole separate video on what the difference is of commodity versus security and why that is. I think I've done videos on it in the past. Let me know if you want me to make another video. And what we saw is that Bloomberg Intelligence did a report about 6 months ago saying that they believe Bitcoin is moving into a risk-off asset. So it's been like a risk-on asset, like a tech stock, but they believe it's moving to a risk-off asset. And the reason why we can already see this happening is that the dollar, the Dixie index has been going up and gold's been trending down, other assets have been going down, but we saw Bitcoin and the dollar going up at the same time. Remember, this is a global asset. So get rid of your very US-centric viewpoint or Western viewpoint if you're in Canada, Australia, or Europe, and think about it globally. And so even if the US is raising rates and is tightening right now, China is easing. Other nations are easing. Other nations are buying lithium and nickel and gold. They're not buying dollars. So just because our US dollar is going up does not mean those other assets, those commodities won't go up. Now, finally, I want to leave you with this, directionality. I can't really tell you what's going to happen in the next 30 days or 60 days, but I can tell you what's going to happen in the future. They are going to print money. When I say, I mean the governments of the world will print money. It's the only way. It's only math. They don't have enough income coming in to exceed their, or to even meet, not even meet their basic expense. They don't even have it for the interest. They have to print money. That's it, period. That is the directionality, but it doesn't mean that it won't be volatile. I have a couple charts here. Here is the Zimbabwe stock market. You can see this peak in about 2013. You could have bought in this peak of 2013, and for 2 or 3 years, it trended down. You lost some money. But then it went up. And that would have been an amazing trade to buy, go in YOLO into the stocks right here and ride them up. But what I want to show you is that it wouldn't have been just a smooth ride. It went down here, it had a big drop here, another big drop here, another big drop here, another drop here, another drop here, another drop here. So even though it was the trade of the decade, if you were living through that, this is about a 5-year period right here, you would have been shaken out over and over and over. Even though you were directionally, remember directionally, you were correct. Also, this is the famous chart of Weimar Republic. This is the mark, the German mark to gold. And you can see from 1914 to 23, over a 9-year period, it went up like straight up. If you would have sold all your paper marks for gold, you would have crushed it. It would have been amazing. But this blue line is the volatility. And so the price of gold was going like this. And so if you lived through that, it would have been tricky and it would have shaken you out. There was a book written, it's called When Money Dies, and they said that everyone sold their gold and everyone sold their houses and everyone sold their assets because they were at the peak and they wanted to sell them before the markets crashed. But at the end, they were left with worthless paper instead of the assets. And the paper was so worthless that they burned it in the fireplace instead of wood because it was worth less than wood. And that's exactly where we're going. It's the only way. It's inevitable. That is the future. It's only math. But what do you think? I'd love to hear your comments down below. Do you agree with the math or did you come up with different math? Break it down for me. Let me know. As always, give me a thumbs up on this video if you like it. If you don't, give me a thumbs down. That's okay. And ignore the scammers down below in these comments. They're trying to get you. It's not really me. That's not my WhatsApp number. But if you do want to talk to me and my team, there's a link in the description. You can book a call to find out how you can work with me, find out what I'm buying and selling, come to my small live events, things like that. If you want to book a call. And that's what I got. All right. Thanks for listening. To your success. I'm out.